So many of you have been asking about getting started with investing. And yeah, I get it. It can feel pretty overwhelming.
Oh, yeah, it really can.
Like, where do you even begin? Luckily, you sent over this awesome article
Okay,
that breaks down some of the biggest myths about investing.
cool.
And I think this is exactly the kind of deep dive we need to clear the air and get you on the right path.
Yeah, a lot of those myths, they're like mental roadblocks,
Hmm.
keeping people from taking that first step.
Totally. And the first one that I think we should just jump right into is this idea that investing is confusing. I'll admit, I've definitely felt that way at some
I
point.
think everybody has at some point.
Totally.
Yeah.
So what does this article say about simplifying things?
Well, it really emphasizes the idea that you can choose your level of involvement.
Yeah, okay.
Like, think about it like learning to cook. You can start with like simple recipes and gradually work your way up to more complex dishes. You don't have to be like a master chef right out of the gate.
So there's no pressure to be like a stock-picking whiz from day one.
Exactly. Like if you want to dive deep into, analyzing individual companies and all of that, that's awesome.
Yeah.
But if you're just looking for something a little bit more hands-off, there are strategies for that too.
Like what? What are some of those simpler strategies?
Index funds are a great example.
Okay.
So think of it like a pre-built portfolio that tracks a specific market index, like the S&P 500.
Okay.
So you're basically buying a tiny piece of the entire market instead of picking, individual stocks.
That makes a lot of sense, actually.
Yeah.
Is there any downside to that approach?
Well, I mean, some people might say that you're giving up a little bit of control because you're not choosing the specific companies.
Right.
But for a lot of people, that's actually a good thing because it takes the pressure off and lets you benefit from the market as a whole.
Yeah, you don't do all the research and the stress as much.
Hmm.
Okay, so less research, less stress.
Hmm.
I like that idea.
Yeah.
The article also mentioned this buy and hold strategy. How does that fit in?
Yeah. Buy and hold is basically a classic long-term investing strategy,
Okay.
and it goes really well with index funds.
Okay.
So basically, you buy your shares and you just hold on to them. You weather the market's ups and downs.
Through the storms.
Exactly. And over time, the market tends to trend upwards, so patience is key.
So even though we see those scary headlines like, oh, the market's crashing, the market's dipping, its history tells us that if you stick with it long enough, you should come out on top.
Right. The S&P 500, for example, it's historically averaged about a 10% annual return,
Yeah.
over the last several decades.
Wow.
Of course, past performance doesn't guarantee future results, but it at least gives you a sense of the market's potential.
Yeah. Yeah, definitely. So we're playing the long game here.
Yeah.
Okay, so we've busted that myth that investing has to be super confusing.
Right.
But what about the financial part? I think a lot of people, myself included, have felt like you need a ton of money to even get stuff.
Yeah.
What does the article say about that?
Yeah. Myth number 2. I don't have enough money to invest.
It's a big one.
It is a big one, and it keeps so many people away. But this article really blows that myth out of the water.
Okay.
You don't need a ton of money to get started.
Really? What's changed? Like, how is that possible now?
Well, technology is a big part of it.
Yeah.
There are all these online platforms that let you invest
Okay.
with super low minimums, sometimes as little as $1.
So you're saying that even if I can only spare like $20 a week, it's still worth starting?
Absolutely. Every little bit counts, especially when you factor in that compound interest.
Okay, we'll get to that.
But even those big name companies that seem out of reach.
Yeah, the ones that everybody's talking about.
You can actually invest in those too, even with a limited amount.
How do you do that? Because some of those share prices are crazy high.
Yeah, that's where fractional shares come in. So
Yeah.
you basically just buy a portion of a share. Instead of the whole thing, it's like splitting a pizza with your friends. You can still enjoy a slice even if you can't afford the whole pie.
Okay, I like that visual.
Yeah.
So the barrier to entry is really not what it used to be.
Not at all.
You can start small. You can choose your level of involvement.
Yeah.
And you can even invest in those big high-priced companies.
Right.
That's pretty cool.
And, you get dividends even with fractional shares.
Oh, yeah. What are those again?
So those are regular payouts from the companies that you invest in.
So it's like a little bonus just for owning a piece, even if it's a small piece.
Exactly. It's a great way to potentially boost your returns over time. And it all ties back to compound growth.
Okay, we're going to get to that.
Yes, we are.
Okay, so we've tackled the myth that it's confusing and the myth that you need a lot of money, but there's another big one out there.
Okay.
And that's the myth of time,
Right.
that I can afford to wait to start investing.
Yeah.
especially when you're younger and retirement feels like a lifetime away.
A million years away.
Right? Why bother?
Yeah.
But this article really emphasizes the power of compound interest and starting early.
It's so important.
So remind me again what's so magical about compound interest. It sounds like some sort of like financial sorcery.
It kind of is. It's like you're earning interest on your interest.
Okay.
So your money's basically growing exponentially over time.
So the earlier we start, the more time that money has to like snowball.
Exactly. And this article gives a really great example.
Okay.
Imagine investing just $100 a month starting at age 25 versus starting at 40.
Okay.
The difference in potential earnings is huge.
Okay, give me the numbers. Paint me a picture.
Okay, so let's say you're getting an average annual return of 8%. You know, the stock market's historically averaged closer to 10%, but we'll be conservative.
Boy.
If you invest $100 each month, starting at 25, after 40 years when you reach 65, you could be looking at a nest egg of over $310,000.
Okay, that's a good chunk of change.
Yeah.
But what happens if we hit the snooze button on investing and we wait till we're 40?
Okay, so same $100 monthly contribution, but you only have 25 years until 65.
Right.
With that same 8% return, your nest egg would be around $87,000.
Oh, wow.
So that 15-year delay cost you over $223,000.
Really? Just by starting 15 years later?
Just by starting 15 years later. And keep in mind, over those 15 years, you would have only contributed $18,000 of your own money.
Right.
The rest is the magic of compounding.
I think we need a moment to let that sink in. That is wild.
Yeah.
That's a really, really good illustration of how that delay can have a big financial impact down the line.
Big time. Time is your biggest ally when it comes to building wealth.
I'm starting to believe it.
Yes.
So it's really all about time in the market, not timing the market.
Exactly.
Okay, but there's got to be more to it than that, right? Like, besides time and how much money you initially put in, what affects how quickly your investments grow?
Yeah, you're thinking about the rate of return.
Right.
That plays a huge role.
Yeah.
You know, in that last example, we used a hypothetical 8%.
Right.
But if you can get a higher return, that snowball's going to roll a lot faster.
Okay, sure. But realistically, how much control do we have over that? Is it all about picking those hot stocks or trying to, like, time the market perfectly?
If only it were that easy.
Right.
There's no crystal ball, unfortunately.
Yeah.
Trying to time the market is so difficult, even for the pros.
So no magic formulas, no insider tips. What's the approach here?
Diversification is key.
Okay, I've heard that phrase before, but what does that actually look like in real life?
Basically, don't put all your eggs in one basket.
Right. Spread the love.
Exactly. Instead of putting all your money into one single stock or asset class,
Okay.
you spread it out across different types of investments.
Got it.
This could be stocks, bonds, real estate, even things like commodities or precious metals.
So like a well-rounded portfolio, kind of like a balanced diet for your money.
Perfect analogy.
I like it.
And the benefit of that is that it helps to mitigate risk.
Okay.
So if one investment does poorly, others might do well, and that helps balance things out.
Yeah, that makes sense.
Yeah.
But let's be real. Even with all this talk about long-term growth and diversification,
Yeah.
there's still this part of me that's like, what if the market crashes?
Sure.
What if I make a bad decision?
It's normal to feel that way.
Yeah.
It's important to understand risk.
Okay.
It's a part of investing, but it's not something to be scared of.
Okay.
It's something to manage strategically.
So we're not running away from risk. We're learning how to, like, dance with it.
Exactly. And that's where those concepts we talked about come in.
Okay.
Diversification, your time horizon, and your own personal risk tolerance.
Right.
You know, if you're investing for the long term, you have more time to recover from those short-term market swings.
Because even if things take a dip, there's more time to bounce back.
Exactly. And, you know, as you get closer to retirement, you might shift to a more conservative approach,
Okay.
prioritizing keeping what you have safe over high-growth, high-risk investments.
So it's all about finding that balance between risk and reward.
Right. And that's why it's often helpful to work with a financial advisor. Okay.
Especially if you're feeling lost or unsure about how to create that diversified portfolio.
Yeah, having an expert in your corner can definitely be helpful. But let's get back to this compound interest thing.
Okay.
It seems like it's really the key to success, and we've talked about time and rate of return. Are there other ways to maximize its power?
There's this strategy that a lot of investors use.
Okay.
It's called dividend reinvestment.
Okay, tell me more. What is that?
So remember those dividends we talked about?
The little bonuses?
Right, exactly. So with a dividend reinvestment plan, or a DRP,
Okay, another acronym.
yeah, well, you automatically reinvest those dividends right back into the company stock.
So instead of getting that dividend payment as cash, I'm using it to buy more shares.
Exactly. And that's where the compounding really kicks in.
Okay.
So those additional shares generate more dividends, which you then reinvest to buy even more shares and so on.
So it's like a snowball effect on top of a snowball effect.
I love that.
I'm full of them today.
And DRPs, they often let you buy fractional shares too.
So even if you're reinvesting a small dividend, you can still get more ownership.
Every little bit counts, right?
It really does. And the earlier you start, the more time that magic has to work.
We've covered a lot of ground here. We talked about diversification, managing risk, and that compound interest.
We did.
I'm feeling a lot less intimidated by investing now.
That's great to hear. Remember, knowledge is power.
Mm-hmm.
And the more you learn about investing, the more confident you'll be in making those decisions.
So what are some key takeaways that our listeners should keep in mind as they start exploring this world?
One of the most important things is to remember that investing is a journey.
Not a destination.
Exactly. There's going to be ups and downs.
Mm-hmm.
But you got to stay focused on your long-term goals and don't get caught up in the day-to-day noise of the market.
So it's a marathon, not a sprint.
Exactly. And just like a marathon runner, you're going to need the right tools and resources to support you along the way.
Like what kind of tools, what should our listener be thinking about? So we've talked about like index funds and diversification and dividend reinvestment. But where do you actually start putting all this into action?
Yeah, it's one thing to understand it.
Right.
It's another to actually do it.
Right.
And this article actually highlights one of the easiest and most accessible ways to get started.
Okay.
Your employer's retirement plan.
Oh, yeah, the 401k, the 403b.
Yeah.
Those things,
Exactly.
those always pop up in like financial advice articles,
Yeah.
but they can feel kind of like a black box.
Yeah.
What are they all about?
So basically, they allow you to contribute a portion of your paycheck
Okay.
directly to a retirement account.
Okay.
And the money grows tax deferred.
So you don't pay taxes on it till later.
Right. You don't pay taxes until you withdraw it in retirement.
Okay, so that's a nice little tax advantage. But
Yeah.
what makes them so special?
The best part is that a lot of employers offer a matching contribution.
Wait, so you're saying my company might actually put extra money into my retirement account just because I...
Yeah, it's basically free money.
Wow.
It's an amazing way to boost your savings early on.
So even if I can only contribute a little bit right now, it's still worth it because of that potential match.
Absolutely. It's like getting an instant return on your investment.
Okay, I'm definitely checking on my employer's retirement plan after this. But what if my employer doesn't offer one? Or what if I want to explore other options?
Okay, well then opening an individual retirement account, or IRA,
Okay.
is another great way to build your long-term savings.
Other acronym.
Yeah.
So what's the deal with IRAs? How do they differ from those employer-sponsored plans?
They offer similar tax advantages, but you have more control over your investments.
Okay.
You decide how your money is invested.
Oh, so it's like more flexibility and customization.
Exactly. And there are
Okay.
two main types of IRAs,
Okay.
traditional and Roth.
Okay. Traditional versus Roth, what's the difference?
So the main difference is in how they're taxed.
Okay.
With a traditional IRA, your contributions are usually tax deductible in the year you make them, but when you take the money out in retirement, it's taxed as income.
So it's like getting a tax break now,
Right.
but paying taxes later.
Exactly. With a Roth IRA, you contribute after-tax dollars, but your withdrawals in retirement are tax-free.
Oh.
It's like choosing between a discount at the register
Okay.
versus skipping the checkout line altogether.
I like that.
Yeah, and the best choice really depends on your own personal situation,
Okay.
your current income,
Okay.
and how much you think you'll be taxed in retirement.
So definitely something to chat with a financial advisor about.
Exactly.
But the bottom line is these IRAs give us another great tool for growing our long-term savings.
They do, and no matter which you choose, diversification is still key.
Right. Don't put all your eggs in one basket. It seems like that's like the golden rule of investing.
It really is. Spread out your investments across different asset classes, stocks, bonds, real estate.
Mm-hmm.
That helps you manage that risk and potentially increase your returns over time.
So as we wrap up this deep dive into investing myths, what's like the one piece of advice you want to leave our listener with?
Remember, you are capable of building a secure financial future.
Mm-hmm.
It might seem overwhelming at first,
Right.
but with each step you take, with each myth you debunk,
Yeah.
you're going to gain more confidence and more knowledge.
It's about taking that first step, no matter how small, and just building from there.
Exactly. And as you continue on this journey,
Mm-hmm.
stay curious, keep learning, and don't be afraid to ask for help when you need it.
Awesome. Well, it has been an absolute pleasure exploring these investing myths with you.
Likewise.
I feel like we've not only busted those myths, but replaced them with a sense of empowerment and possibility.
That's what we like to hear.
Right. Investing is a journey, not a destination.
Exactly.
Enjoy the process of learning, growing, and shaping your financial future. And to our listener, thank you so much for diving deep with us today. We hope this episode has given you the knowledge and the confidence to take control of your finances and build the future you deserve. You got this.